The covered combination is a three-part strategy that includes long stock, a short call, and a short put. This strategy may be considered when one has a neutral outlook on the stock and is looking to enhance the return of a traditional covered call, or wouldn't mind purchasing additional shares of a stock on a pullback. You already own 100 shares of stock for each covered combo you plan to sell on a stock that has a narrow trading range. In order to generate income, you begin by selling one out-of-the-money call. At the same time, you sell an out-of-the-money put with the intention of generating additional income, but also wouldn't mind purchasing more shares on a stock pullback. At expiration, if the stock price is below the strike price of the call and above the strike price of the put, then both options expire worthless and you get to keep the premiums. Should the stock rise above the short call strike, you would have the obligation to sell shares, which would close out your original long stock position. Should the stock drift below the short put strike, you would have the obligation to purchase shares, which would increase your long stock position. With the stock trading in a narrow range, time erosion of the two short out-of-the-money options works in your favor. Time decay accelerates as expiration approaches. You already own 100 shares of XYZ at $81, and you're looking to generate additional income. Looking at the options that expire in 30 days, you choose to sell the 85 strike call for $1.25 and sell the 75 strike put for $1. For a combined credit of $2.25 or $225 per combo. Should the stock rise above the short call strike, you would have the obligation to sell shares at $85, which would close out your original long stock position. Because you collected $2.25 for the combo, your effective sale price would be $87.25. Should the stock drift below the short put strike, you would have the obligation to purchase shares at $75, which would increase your long stock position. Because you collected $2.25 for the combo, your effective purchase price would be $72.75. The maximum profit is when the stock is $85 or higher at expiration. Profit is limited to the $85 strike price, less the stock price of $81, plus the premium received for selling both the call and the put. With the stock at $85 or above, the short call obligation to sell shares negates any further profits. What happens at expiration if XYZ is between $75 and $85? If the stock stays between the strike price of the call and put by expiration, both options will expire worthless and you can add $2.25 to whatever the stock P&L happens to be. What happens at expiration if XYZ is $75 or lower? At $75 or lower, you have achieved your secondary goal of buying additional shares of stock at a lower price of $72.75. You now own 200 shares at a lower average price than your original stock position and have the ability to generate additional income by selling more calls on your new stock position. To learn more about the covered combination and other strategies, visit the OIC website at optionseducation.org.